So I'm Barbara Van Allen. I'm the president and CEO of the club, and it's a pleasure to be here with all of you. And thank you for those of you that made a point of getting here early, given the mass for our Pope across the street at noon. Before we begin, I want to extend a warm welcome to students joining us virtually from the CUNY Graduate Center and Rutgers University, as well as members of the 2025 class of fellows, a select group of diverse, rising, next-gen business thought leaders. The Economic Club of New York is proud to stand as the nation's leading nonpartisan forum for discussions on social, economic, and political issues. And for more than a century, the club has played that role, and we're delighted to carry on that tradition today as we welcome our distinguished guest, Dan Loeb. Dan is the CEO and founder of Third Point LLC, a $20 billion asset management firm started in 1995. Third Point's flagship hedge fund invests primarily in public equity and credit securities. Third Point also offers dedicated corporate, private, and structured credit funds and owns TB Birchgrove, a credit asset manager with over $5 billion in collateralized loan obligation business. Third Point also owns Malibu RE, a life and annuity reinsurance business. Dan has served on several public company boards and actively engaged with numerous global corporations to improve governance and shareholder returns. He's a member of the Council on Foreign Relations and a trustee of the Mount Sinai Health System, where he established the Ronald L. Loeb Center for Alzheimer's Disease in memory of his late father. He's a longtime trustee and former board chair of Success Academies, a public charter school network that I'm sure many of you have heard of. In 2022, Dan was honored by the UJA Federation of New York with the Gustav L. Levy Award. He was awarded the Alexander Hamilton Award for his philanthropic service by the Manhattan Institute and received Columbia University's John Jay Award for distinguished professional achievement. He graduated from Columbia University with an AB in economics. Today's program will be a fireside chat, and we're honored to have co-anchor of CNBC's Squawk Box, Andrew Ross Sorkin, as our moderator. As a reminder, this discussion is on the record. We do have media in the room and online, and we are going to end, as we always do, promptly at 1 p.m. Now, with further ado, please join me in welcoming to the stage Dan and Andrew.
Any preference?
Whatever your choice. I think it's a speaker here.
A moderator here. I'm here.
So there we go. We'll go this way. Well, thank you. Thank you, everybody. It's a privilege to be here. I've had the privilege of knowing Dan, I think, now 25 years. I was actually going back to think about when we first met. And back then, you used to call yourself, though everyone doesn't need to know this, Mr. Pink.
Thank you for starting with that.
When he was an activist, and you still are, but now you're a wise old man in this industry, and you have a lot to tell us. I think we all want to know what you think about this market, the policy and politics of what's happening in this country, the Fed, and everything else. But before we get into all of that and get into also the industry, because I also think one of the things that's fascinating is just the evolution of.
Can I just interrupt you for
yes,
one
sir.
second? Because you're reminding me of when we actually first met. I think this was one of the great flexes I've ever heard. We were walking down the streets of Davos when I used to go there, and it was still a relevant organization. And I was so impressed by how accomplished he was. I said, wow, you must have been editor of the school paper at Cornell. He said, actually, when I was at Cornell, I was already working for the New York Times. That's my first memory of our meeting. And it was a good flex.
I remember being on a bus with you is what I thought, but okay. Anyway, I want to start with actually how that, before we get into all of it, just how this whole thing started for you, because there's sort of a fascinating story, sort of an origin story about how you even got into this business, the office, by the way, that you used to live in when you first started your firm. Tell everybody how it actually began.
Well, I'll try not to go into too much detail because we'd spend the whole time on what the conditions were of my childhood, who inspired me and motivated me to go into investing, all that stuff. But why don't we pick up, around college, I started investing in the market. I was doing great trading my personal account, and I kept leveraging my account. I had two companies in it, Coherent and Puritan Bennett, and I turned $7,000 into like $120,000. And then within the same day, Puritan Bennett, which was like an air provider, had a patient die on it. And then Coherent had some other problem, and my account was completely wiped out. And I went $7,000 in debt from $120,000. And it took me 10 years because my dad lent me the money to pay him, to pay for my taxes that were due. And it took me until my first bonus check at Jefferies to actually pay him back, which is what I did. But it was an invaluable lesson on risk management, and also how long it takes working regular jobs in your 20s just to save a few $1,000s. After having a few, sorry, did you want to?
No, go.
So after having a few jobs, I landed at Jefferies as a distressed debt research analyst. And I was probably about 29, and I was working with people it was sort of like the entry-level job. It was like people I worked with were like 23, 24. It was a junior position that I took, but it was really the greatest launch into the business that I could have imagined. It was post-Drexel blow up. So I started after Labor Day in 1991. Drexel had blown up in February. It was 10,000 hours, like right out of the gate, with more credits, more distressed, and an incredible team of people who were ex-Drexel. So it wasn't, it was a sharp-elbowed group of people. So I learned a lot about the credit markets. I learned also how to navigate, about the most alpha group of individuals that you can imagine. And that cultivated in me like this passion for not just credit, but all the machinations that go into finding situations, understanding special situations, resolving complex things, and also dealing with the trading elements of it, which I think a lot of people don't have that exposure to if they're too cerebral about it.
And then somehow you decide you're going to start a fund, and you call David Tepper.
So I'd had one investor who was a good friend of mine, a psychiatrist, who gave me $400,000. He said, just when you find good situations, invest them for me. So I remember there were the Drexel CBIAs that I was the analyst on. There was integrated resources, or a bunch of things. And these were crazy returns in those days. So that was the time. We'll never see another distressed market like that again. But his $400,000 turned into $1.2 million. I enjoyed the principal part of the business more than I enjoyed the transactional part, although the transactional part was great because it allowed me to build a nest egg to start my fund with. But I started with $300,000 that I'd saved, $1.2 million that $400,000 became, and a few other friends and family. I started with $3.2 million in 1995, and I was off to the races.
And you did this from an office that really was the gym of David Tepper. Is that true?
Yeah. So I could have. I realized the value of being around other smart people and the credibility I would get just being. And we had developed a close relationship. He was my top client. I had cold called him actually when he left Goldman after his famous blow up there for not being made partner, not being paid enough. And anyway,
hold on, just go back. You call him up. David Tepper doesn't like to take a lot of people's phone calls. So how did this happen?
Well, I called him. I said, "Hi, I'm Dan Loeb. You don't know me." And I was the lowest. I went from research to sales. As the lowest person on the totem pole, I had no clients. I had to develop them. So I found clients in Canada. I found people all over. I thought this guy Tepper might be a good client. And he was very nice. I mean, he, very gruff, very like matter of fact, and extraordinarily smart. And anyway, he said, "Yeah, send me your research, and if I want to do something, I'll." So anyway, when he hung his shingle, I was in pole position to cover him, and we had a really good business relationship based on finding good ideas for him. And then when I left, I asked him if I could have a if I could sit in his office. I mean, you couldn't do something like that today. I don't think the SEC likes like different firms sitting and getting access to the flow and everything else but it was, what we're doing was different enough. And anyway, he put me in his weight room.
So like in the weight room, like the desk is the bench?
The desk was a desk. I think it was missing a leg, and we had to it was really a rickety old leg. And I looked at this old Nautilus machine, if you remember those, and I don't think anyone ever used it. But anyway, that was how things. I only stayed there for 6 months. Then I moved to a shared base Bear Stearns had. Okay,
so we're going to fast forward 30 years. This is a letter that you sent February 5th, 2025 to your investors. And maybe you can speak to what's going on. You said, overall, Third Point expects the environment for investing in equities to continue to be favorable, with the caveat that there will likely be periodic dislocations caused by the unconventional approach of this administration in conveying and enacting policy that affects markets and the economy.
What say you now? Some wiggle room. I remember in March of 2009, I think it was on the day of the market bottom, I wrote a letter that said brace for impact. And I told people that this was going to be really bad. And, we were net short and we missed the 20% bounce off the bottom and then we flipped. So I think, look, we all, and I think the letter accurately reflected that. I mean, you can't, anyone who makes like a single pointed prediction about the market is probably a sell side market forecaster but I don't know any principal investors that do that. And I think I did recognize that things could change and things change very quickly. I don't think any of us anticipated going into the year that there would be, look, the stage was set for an environment that was going to address our deficits by cutting expenses dramatically, through deregulation that would promote growth, and yes, tariffs were on the menu, but everybody thought they would be handled in a more conventional way, let's just say. And I think, obviously what's happened since then is a process that has not been conventional. You can ask yourself.
I was just curious. It's not conventional, and we're in this moment where equities are down, the bond market's down, unusually also the dollar is down, which may speak to, people talk about the selling of America. So my question to you is, are you optimistic about where we are right now? Are you pessimistic about where we are right now?
I'd like to say I'm realistic about where we are. And by that, I mean, there's a much wider range of potential outcomes of what could happen right now than at the beginning of the year. There's a left tail that could be a consequence of trade negotiations not going the way they want to, faith and confidence in the United States as a reserve currency. It's not just a reserve currency, it's a reserve bond market, it's a reserve stock market. And you're seeing this giant whooshing sound of capital flowing back to its sources. Add to that the fact that, for better or worse, these trade deficits that we incurred had a capital surplus on the other side that got invested back into the States. So you have a lot of capital going out, both from just confidence and lack of trade, and at the same time, there's an immediate slowdown in any kind of capital investment, spending, M&A, IPOs. So everything's kind of ground to a halt, more or less.
I guess the question, though, is, do you think the toothpaste can actually be put back into the tube?
I would not underestimate the resilience of the American economy, American industrial base, the desire for people to come here, to invest here, but it's not going to happen under the current status quo. I think time is running shorter and shorter for these issues to be addressed. And, we need, somebody I read said something about putting some wins on the board. We need some points on the board. We need a Japan deal. We need a Europe deal. We need maybe an India deal. And obviously, ultimately, if something happens with China, I think this will, I'm not saying things will go back to exactly how they were before, but and I don't think they will. And it'll come with a cost.
What do you mean by that when you say you don't think they're going to go back to what
I
they
don't
were
think that
before?
look, I think that there will be a residual concern about some of the capriciousness with which some of these issues have been dealt with, and confidence in the rule of law, in expectations being met, all the things that lead to, look, there's a lot of things that made us the most liquid, deepest, lowest cost source of capital on the planet. And every time you do, I go back to like the GFC, and when this may seem sort of wonky, but when the GM senior debt was subordinated to,
Right,
for political reasons, to the debt held by the obligations to the unions, and that was for political reasons. It didn't follow the letter of the law. It didn't follow the rule of law. That ultimately has a cost in the future for people to raise capital. When the GSEs were confiscated by the government, even when they were liquid, and they just took the distributions that should have gone to the securities, all these things come with a cost. And maybe it's, at times it's maybe very small, very incremental, but I think what you've had right now is a big cost. So I think anything they can do to restore the confidence in the financial markets, rule of law, consistency, I think will help us get back on track. Now, they would argue that this is all necessary to do to get equitable outcomes, and we can all see that there were ample opportunities for reform around some of the trade policies we have. Like, I totally agree with the intention of doing this. They would say that this is part of some kind of art of the deal process, and let's see what happens.
Let me ask you one related piece to this. So one of the things that's happened, and it just happened the last 48 hours, is the Chinese, and it relates to a lot of people who are in the asset management business. The Chinese basically said, look, we're actually not going to be funding through our sovereign wealth fund and other things, private equity firms, potentially hedge funds and others in the US. That's a new chess piece in all of this. And I wonder how you think, A, that plays out, but also whether you think other countries notice that chess piece and say, actually, you know what? We're going to use that chess piece in our conversations now, too. And sort of, again, this goes to the toothpaste out of the tube. Maybe you can get some of it back in the tube, but can you get all of it back in the tube? Yeah,
they are definitely doing that. I know somebody who has a private equity firm, had a plan to sign a multi-$100 million deal with the Chinese sovereign wealth fund, and they yanked that. That was like 3 or 4 weeks ago. So that's
real.
Yeah, that's real. I don't think the other large sovereign wealth funds in Singapore or in the Middle East, I've talked to them about it. I don't think that that's something that they're contemplating as a policy issue. First of all, they have not been aggrieved the way the Chinese have been. There haven't been any trade policies or other geopolitical things that have disadvantaged our
Right.
friends in the UAE.
I just wonder whether you think Canada, teachers in Canada, or
Yeah,
Norway.
I haven't looked into it. I don't think Norway. I don't know. Yeah, certainly. I mean, that's a tool. Look, Trump's pulling out all stops. I think if people don't like if they think they're being treated unfairly, that's certainly. But remember, they do need us. They need our. Norge's bank has, I don't know how many trillions of dollars or a trillion. I mean, the market here is so big, it just can't be ignored.
So what do you think an outcome is that would be good for the country and also good for markets?
I think resolving the tariffs, walking away from this idea of taking over the Fed, or installing a new Fed Chair, because I think that also feeds into this uncertainty. Look, I think that at any time in markets, there's sometimes you can identify one thing that matters, and this is the thing that matters the most right now.
You raised the Fed, so I'll raise it with you again. Have you had conversations with, by the way, anybody inside this administration say, stop talking about the Fed, like this is a bad idea?
I have not, but technically, I think sometimes you have to take him at his word. Sometimes, it's bluster. I think well, first of all, there's the Humphreys Executor Act that's before, I think it's the Supreme Court. It's going to be decided in the next few months. So the FDR fired this guy named Humphreys, who was so distraught over this that he died. And then the reason it's called the Humphreys Executor Act is because the executor sued the government for his back wages. So that's sort of that's a critical event. The question is whether, I won't go into all the details, but there are technical kind of plumbing issues around the FOMC and his ability to even control this that kind of calls into question whether or not that would be a smart move, even if he wanted to get control of the Fed. So I don't think that's going to happen.
Is there somebody you'd like to see be the next Fed chair? And what do you think about the idea of a shadow Fed chair? This was something Scott Bessent raised before Trump won.
I mean, Kevin Warsh's name has been thrown around. He'd be great. I don't really know who else has got their hat in the ring.
Would he be dovish enough? The reason I ask is part of what I think the president wants is he wants lower rates. And do you think, by the way, that this Fed chair is making a mistake about the rates?
Gosh, we're going to talk about like activism and
we're going there. We're about
to really test. I know it's the economics club.
We're going.
I went to.
You run a credit operation now.
No, but you're right. I mean, these are the things. Being an equity investor right now, for all intents and purposes, being a macro investor, if you're going to have any kind of directionality in your portfolio. So these are all things that we do contemplate frequently. But in terms of I try to be as apolitical and distance myself from these things, whatever my personal views are, I just try to look at it more surgically and think about, what are the range of possible outcomes? What are the strategies that are going to work? I haven't really thought through the policy implications, putting myself in the seat of somebody who's going to make these decisions. So,
okay, here's a different one for you before we get to activism, which is, so we got a whole bunch of questions from members, by the way.
Okay, great.
And one of them is there any stock or sector that can withstand the unpredictability of President Trump? Where should investors look for safety? Are you into Bitcoin, for example, or gold or other things like that?
Unfortunately, I did not, unlike my friend David Einhorn, I didn't catch the gold bug at all. And he's been spot on that. And some other people, I saw John Paulson just bought a gold mine. Bitcoin, I've kind of recused myself from doing anything in crypto.
Why is that?
I've had some unpleasant experiences in the crypto space.
Do you want to tell us about them?
I think it's well known that we invested in FTX.
Yes.
So that was
And then you decided you were out.
I decided I was out after that. Maybe sometimes it's like the cat jumping on the hot stove. You never jump on that stove again. But also it caused me to focus on what I do have more. Look, the crypto world has some ultra high IQ, very plugged in people. There's no way I'm going to compete against, the poly markets of the world. And there's a lot of really smart people who do that. So I don't have a view of crypto as an asset class. I'll tell you, I don't know that there's an industry per se, but what we have done in the last few months is, number one, shifted away from those easy sale candidates of stocks that had been the big winners, but that are the easiest to sell from a technical standpoint from people who are repatriating their capital and getting out. So we've largely sold out, and we did it fairly well. We sold out of our Mag 7 holdings early on. We got out of Meta and reduced our Amazon. We got out of basically all of them. Still have a small Amazon position. I think as a strategy, what we're looking at is event-driven strategies and activism. The activist positions we have are either very conservative or hedged, and the event-driven strategies are things where, or, I'm sorry, the M&A, the ARB strategies are just things that the deal's going to close or not close,
Right.
irrespective. I mean, there's still an element of public policy analysis because you have to figure out what antitrust or other regulators are going to do. So that's been kind of our, MO and how we've been protecting
Can you
capital.
just speak? It's a sort of broader question about activism. I called you Mr. Pink when this began. You used to write these very provocative letters that made great copy if you were a reporter, by the way. And over time, you don't do that anymore.
Wow, that was 25 years ago.
I know,
Andrew.
So, but I want to understand sort of.
They weren't letters. They were posts on these public like chat boards. It was like a Reddit of the 90s. And I created this rather humorous, I mean, mind you, I was running $100 million at the time. Wasn't expecting to become a big institutional fund. It was fun, and we're very active short sellers. So mostly what I was doing was identifying mostly fraudulent companies and talking about them in a kind of
disparaging way
and bringing that to the attention of the greater public. But then when my general counsel joined me, he said as a condition to his joining, I would hang up my cleats as Mr. Pink, which I have done.
But then you continued to send letters. You'd actually send letters to companies, though.
But that wasn't that was taking. So our first activist position was in 2001. Sent to Bill Sturritz when he tried to steal a company called Agribrands on the cheap. Acquire it for a very low price, five times EBITDA. And we wrote a letter. Remember, Glenn Dubin called me and said, hey, why don't you go activist? I said, you own 9.9. I only own 7% of this company. He goes, yeah, but we don't do that. So anyway, that was my first activist investment. And my lawyer, the great Jack Nussbaum, may he rest in peace, helped me write this. And I was shocked that the managing partner at Wilkie Farr, he took such glee in kind of, he really enabled me in many ways. I mean, I wrote it, but there were some turns of phrase that he, and he was my big, he and the other lawyers there. Today we have a guy named Tariq Mundia, who's great, but he was like my impetus, but kind of really encouraged me to pursue these activist investments.
But you do it differently now, meaning.
Well, early on, again, they were small cap companies. The behavior was really outrageous. I mean, if you look at some of our early letters, we identified just misuse of corporate funds, the yachts and limos and the usual stuff. People find someone on a golf course at 2 PM, but it was also, again, look, there's 3 levers that you can use in activism. There's a financial lever, legal lever, and then I think what I'd say pioneered alone. There were a few other people did, but the social pressure lever was the one that we pulled because we didn't have enough to like buy the whole company or whatever. But I'd say as we evolved as activists, as I evolved as an activist, we started to go after much bigger companies. And I think the approach is just completely different. And I think also the turning point was really when we got on the Yahoo board. And these were like serious people on the board. I remember Brad Smith, the CEO of Intuit, was on the board. And there were other people who were, so then I think that was more of like a acculturation process to acting in a business-like, in a more traditional business-like way to achieve an outcome. And, again, we repeated that at Sotheby's. And then in different ways, we engaged with some very, very large companies and accomplished some outcomes that you wouldn't expect. I realized that with even a couple percent ownership in a company like Nestle, we were able to get them to completely change the trajectory of the company. We got them to get rid of their kind of local parochial Swiss board, bring in some international people. I got them to articulate a capital allocation strategy, share repurchases, better define what they do in IR. So, and we've done this with other large companies.
But it no
Dow.
longer requires writing a nasty letter.
On the contrary. So I think the most recent one would be CoStar Group. We came on the scene. We, along with, coincidentally, there was another activist, D.E. Shaw. We engaged with the CEO. There were 3 things that we really wanted, and they were, we needed better governance to get there. And coincidentally, he was in a process of wanting to upgrade the quality of his board. So it actually played in well, because usually these board transformations take years. I think in 3 weeks, we got them to replace 3 of their board members, number one. Number 2, we got them to agree to a comp package that was based on real value creators like TSR, total shareholder return, return on invested capital, things like that, as opposed to a revenue-based comp package, which was not, what we want to ever see. Third, we got them to agree to a capital allocation committee. Without getting too granular, it's a great company. It has a business that's been a sinkhole for cash and capital for the last 2 or 3 years. We think it's risky, and we're skeptical, but not dismissive of the possible success of the business. So we got them to, we would have shut it down immediately. He said, look, give us a year. But we think the company's market cap is being punished by about 20 to 30%. Right. So they agreed to a year kind of capital allocation, a committee that will evaluate this over the next year and determine whether or not. So that was how we approached it. But there was no evidence of our fingerprints on this until there was a press release that came out announcing a settlement and a standstill, and our work was done. And by the way, I'd say one of the other differences is all of these people that we have initially come on as activists, uninvited, phenomenally good relationships with them.
One of the questions that one of the members asked, it's a very astute question. I'm very curious what your reaction is. They said, any thoughts on the recent changes in Delaware law and the rise of Texas's new stock exchange and court system, given that you're in the activism business?
It's funny because we have our entities incorporated in Delaware, and I asked my GC about this. I think there's been enormous overreach by the Delaware judges, whoever adjudicates these things, determining what is fair or not fair for CEO compensation. So I think it's I think that's out of bounds. I think it's for shareholders to determine. And I think it's understandable that public companies would go to a venue that doesn't overstep what should be their duties around securities and corporate law, and not opining on whether CEO comp. Look at what a mess it's made in the UK. They can't attract the best CEOs because of the kind of socialist tendencies to not want CEOs to make a lot of money. But if you're Elon Musk, you've created this incredible enterprise, your shareholders are behind you. Why should a court in Delaware determine what your comp is? So,
well, it's interesting because I would think that you would want a state that you would want most companies to be in the most shareholder-friendly state.
I mean, they're shareholder friendly in certain ways, but I understand I understand why corporations wouldn't want that kind of overreach on their CEOs.
Back to your firm for a second. One of the things that I don't know if people fully appreciate, we talk about
my what? I'm sorry.
Back to your firm. I think a lot of people think of you as an activist investor, but close to 50% of your business is now a credit business, and that's a real transformation.
Yeah.
When did that happen? What was your thinking? And what do you think it looks like 5 years from now?
Well, I love the core business we're in. I love equities, although I don't love the sleepless nights or the totally crazy things that come out of left field that change expectations in markets or big drawdowns or things like that. But I do love the process. But we've always been a credit firm. I was born as a credit firm. Third Point was a distressed debt, and high yield firm. We were kind of, a third when we started. That was the initial vision. It was only after the credit cycle, which was really the only thing I knew from 91 to 95, was just investing in distressed debt and mispriced high yield bonds. It completely evaporated in 1990. But by the end of the year, in 1995, it had almost completely gone away. So I had to reinvent the firm as an equity firm. And the advantage of being small and not having big institutions is that I could do pretty much anything I wanted to do. Eventually did venture capital out of the fund. We did, sovereign debt. We did a lot of things. So it was clear to me, our credit team has always done a phenomenal job. Our ambitions in credit were always to diversify our returns, generate kind of a steadier, less volatile stream of income, to retreat from credit markets when spreads are tight and opportunities are few, and to go all in when things are more robust. So in 2008, we were down 30. In 2009, we were up over 30, 2010, and that was all credit driven. So I find that in times of crisis, even though equity might also do very well, as an example, during COVID, we had a big drawdown going into it. And anyone who invested in equities at the bottom of the market in COVID did very well. We took a different approach. We went all in investment grade credit. We made 30 or 40% on those investments in a few months, similar to the equity markets, but I would argue a better risk reward. So we've always been involved in credit. We have big plays, as you probably remember, in Greek debt and in Argentinian debt, and we have a successful structured credit business. But I watched all these, and we've also been investors in alternative asset managers like Brookfield and Apollo, and students of the space. So I looked at the enterprise value being created. I wouldn't say that was number one. Number one was I wanted access to opportunities in the credit world that I wasn't getting through public high yield and structured debt. And I realized I had to I had to elbow my way into the party in the private credit world. So a couple of years ago, we hired a person and ultimately a team from New York Life to do sponsor financing and private credit. And we ultimately decided to do a BDC and a vehicle designed for insurance companies. At the end of the year, we acquired Birch Grove. We bought a $5 billion CLO business and a $1 billion credit solutions business. In May of last year, we started a reinsurance company because along with doing all the kind of interesting, stressed or higher yielding stuff, we wanted a home for, as I say, we like to ingest our own exhaust. So we were creating a lot of investment grade securities that traded at a big spread to what comparably rated corporate debt would generate, but we had nowhere to go with it. We would just sell it into the market. So for my main fund, I wouldn't be excited about a 7.5% yield versus a 5.75% yield for a corporate bond, BBB, let's say. But if you have an insurance company and those things are 10 times levered, that's a huge return. So anyway, I put together this group of businesses, the reinsurance company, the private credit sponsor business, the insurance solutions business, and the CLO. And we're right now, I'd say, in the 8th month of the gestation period, and about to launch the BDC, the structured credit business, and create this.
Do you think ultimately that's a way bigger business on the equity side of your house?
I think the equity, I equate our equity business to Mark Rowan's private equity business. I think it'll always be part of what we do. It's in our DNA. There's amazing opportunities there, but the size of the market, the characteristics of the yield, the total return, and the investor base on the private credit side is just massively larger.
You mentioned, by the way, investing at during the pandemic, and you did catch close to the bottom. Is there any part of you that looks at this moment as that? And is there a way to sort of what would you look to even have a clue about how you would even know where a bottom would be in this context?
I don't think so. I think, if I look about like the other inflection points, first of all, the market is not as absolutely cheap as it was in 2020 relative to normalized earnings. And also I think we had a different kind of if I go back to like 2009 when I had sort of my revelation, it was, I say about it's always about one thing. Sometimes you don't know what the one thing is. Then it was the stress tests. So I felt like when I understood the stress tests, I understood that I almost got giddy, and I wrote about it. I said, I used the term kid in a candy store when I described the opportunity set then. But that was a more, we had a very different kind of a financial system, and the problems, the brokenness of the financial system was largely behind us. I don't think that's the case today. Doesn't mean that that the markets can't rally from here, but I think that I don't want to say what I think the relative probabilities are, but there are some probability. Look, what the macro people I know who are very bearish right now, and most of them are looking at their mental model is, and because they don't really like get into individual companies, they look at 250 of S&P earnings, and then it's a debate about, is the multiple 14, 15, 18 or whatever, and then they say the market should be at 4,300. And that's, I think that's a reasonable, no one can say that's irrational. That's certainly on the table. And the challenge for me as an investor is, how do I avoid those companies that are going to trade, that are going to decline as much? What are the strategies that I can employ that will succeed? I talked about risk arb and some of the event-driven stuff. And then separately, how do I really, how do I make sure I have the liquidity to take advantage of what will be an extraordinary opportunity for distressed debt and credit in that kind of an environment?
So you think that environment is coming, though, it sounds like.
No, I didn't say that. I just, like I said, you have to, I think about it completely in terms of different scenarios. And just to be clear, we're not like we made money in 2000, 2001, 2001. We made teens because we were net short. We made a bet that the market was going to go down. And then we lost a little bit of money in 2002 because we were a beat late covering our shorts. But then we made a lot in 2003 in distressed. I don't have that kind of clarity right now about what the outcome is going to be. You don't have first of all, the valuations aren't as elevated. And I just think there's just too much dispersion in no trade deal versus good trade deal about what the outcome.
Let me ask you one other, it's a policy question, but it relates to your ARB business, which is, I think there was a real expectation under this administration rather than the last administration that lots of deals would close, that there'd just be it'd be easy to do a merger. Now it feels different. How do you think about that? About how either the FTC or the FCC or the DOJ is going to be reacting to all of this?
When you embarrassed me at the beginning of our talk with my letter about the rosy outlook in February, that was the just kidding. But looked at me like we're old friends. We like to.
We've known each other a very long time.
Anyway, when my outlook was more optimistic, there was Goldman Sachs stock was 600 and something. I mean, people was, as they say in the south of France, yalla, yalla, yalla. I mean, it was like time to party. There were IPOs in the docket. There was M&A. There was, reduced regulation. I think those deals are not canceled. I think they're on pause. And I think if you get, some resolution, I don't know that it will be as because they also have, I wouldn't say that we're going to have like the anti-Lena Khan administration, but I don't think it's going to be anywhere near that restrictive. So
Right.
I think it could definitely come back. I think there's more appetite for M&A than people realize.
We're going to probably have to wrap up in a little bit, but let me ask you a couple more questions. And this is where your PR team is going to get nervous. Let's talk about X.
Okay.
You spend a lot of time on X. I also want to ask you about what you learn on X, because I feel like that's that's sort of like your news feed these days.
Mm-hmm.
How do you read it? How do you decide to post? How does it work?
First of all, and I know you've diversified from your.
I'm as addicted, unfortunately, as ever. I'm doom scrolling all the time.
But you're one of the smartest journalists I know, because you realized early on that tethering your career solely to being a business writer for the New York Times was not a good idea. You're very talented.
I love the New York Times.
You're a filmmaker. You have Deal Book. You have all kinds of other things that you're doing, but you can't I do read the papers in the morning still, but the information that, first of all, there's like incredibly smart people on X. So there's macro people, you're getting real time, and also the time, like, if you're not going to wait to read Nick Tomorrow, how do you say his name? Nick Tomorrow's?
Nick Tomorrow's.
You're not going to wait to read his thing in the Wall Street Journal the next day. When he comes out with a tweet, you better know it, because he's the Fed whisperer and he has a real insight. And there are people like that. And then there's people who have thoughtful things. I've learned a ton about AI and, reading what Gavin Baker writes, or other Brad Gerstner, or a lot of other people, so there's a lot of very good content on there. The other thing I would urge everyone to do is Grok is an extraordinary AI LM. I mean, if you think about if you go onto ChatGPT, there's things that it's very good at. When you think about the value of AI, it's really, the most valuable AI tool is the one that, if you assume it's ingested all of the content in the world up till a year ago, that's pretty good. But Grok is the only one that has this access to Twitter or X as a data set, and they'll tell you what's been going on up until like 30 seconds before you.
Have you used it in an investing context?
All the time.
How?
Just for sifting through complex data, getting access to information.
So give me a prompt that we should all use.
I don't know. I can't think of anything off the top of my head, but I mean, there's stuff all the time where, stuff relating to AI rollouts, or I want some access quickly to, power usage or different products that people are using and building data centers or whatever. I mean, it's extraordinary how much, I didn't do it, but my friend Martine, who's a mutual friend of ours, would have done this. He would have put into ChatGPT or Perplexity, what would an interview between Dan Loeb and Sorkin look like? What would be some thoughtful, I urge everyone to play with it and do it for yourself, but we're also using it in I know this is not an X question, we're also using it in our private credit business. Like there are applications out there that will go into a data room, synthesize all the information, bring it back to you, create charts and graphs, and synthesize it. But no, I think it's invaluable for that kind of stuff.
Okay. The other thing that X is invaluable for is for you to share your ideas.
Yeah.
So oftentimes you're talking about investment ideas, but I know we got to go. But I want to ask before we get there, one of the big topics of conversation in the past 2 weeks has been what's happening with Harvard. And you were very outspoken online around Columbia. You had given money to Columbia.
Mm-hmm.
I think you were very frustrated and upset about the anti-Semitism taking place on that campus. You stopped being a donor, I believe, to Columbia.
I transferred my gift to Yeshiva University.
So tell us about that, but I'm also curious about how you're thinking about what you're seeing right now with Harvard, because I think there's a lot of people who are trying to make sense of what's happening.
Thanks for the easy question. I mean, look, I'm
Save it for the end.
and I don't think you have to say, look, I'm Jewish and I feel this. I think as a human being, like when you see what's going on and the attacks against Jewish kids on campus, the normalization of anti-Semitism, anti-Zionism, the glorification of terror. Like we've never seen anything like that. You know, back to like the hippies in the 60s, they're burning flags or whatever, but they weren't glorifying murders like this. And just I don't want to get into a whole thing about Zionism or whatever, but the way Columbia handled it, the way Harvard handled the attacks on the Jewish students and the disruption of the class and the support coming not just from these radical students, but from these radical professors, it's disgusting. And I loved Columbia, I loved the core curriculum, and unfortunately, the school had been hijacked by a few radical teachers that brainwashed their students, and a few students that came there with the express intent to radicalize other students and lead these, protests, without a mention of the hostages, without a real understanding of what's going on. So, I've not been shy about expressing that.
What do you think of the Harvard situation?
I mean, I don't know. I'm not like an expert on Harvard. I know we're really getting like the music going on.
The music's coming.
And that look, it's a very extreme way to deal with what was a very, very severe problem, and I don't think I can really weigh in on a broad question like that, except that I wish they had, when they had the opportunity, when they had Rabbi Wolpe on the anti-Semitism task force, they had an opportunity to actually address it. When they could have put someone, they had to dismantle their menorah because it would be defaced and destroyed. But they could have done a lot more than they did.
We're getting the hook. Dan Loeb, everybody. Thank you very, very much. What a conversation.
Yeah.
Thank you. Thank you. Thank you.
Thank you.
Thank you.
Well, thank you both for your time today. And I'm going to just really quickly run through the month of May. For the club, John Bolton will join us May the 8th, the former U.S. ambassador to the United Nations. Ron Barron, the founder and CEO of Barron Capital, will join us May 13th. Niall Ferguson, the Milbank Family Senior Fellow at the Hoover Institute at Stanford, will join us, and that will be a reception on May the 14th. And then, of course, we'll bring into the end of the month, May 29th, a virtual event by popular demand from our members. Once again, Glenn Hubbard and Larry Summers. So we encourage you to mark your calendars and join us for these exceptional programs. And before we close, I want to just take a moment to recognize those in attendance that are members of the Centennial Society, as their generous contributions help to make our program possible. So to virtual participants, and we have as many participating virtually actually as we have in the room, we look forward to seeing you next time. Thank you for joining us. And for those in the room, please enjoy your lunch. Thank you.